Yes, Nicholas, kindly read for us.
Um, all right, so May 2022. All right, so question one. Now Limited on April 1st, 2019, acquired 60% of the 75 million equity shares of Shome Limited. Now, the acquisition was achieved through a share exchange transaction of one share in Now Limited for every 3 shares in Shome Limited. At the acquisition date, the share price of both Now Limited and Shome Limited were 4 cedi and 2.50 each, respectively. In addition, Now Limited will pay 1.4 Ghana Cedi cash on 31st March 2020 for each share acquired. And the cost of capital of Now Limited is 10% per annum. So the statement of profit and loss and other comprehensive income was given.
Okay, so quickly jump to the requirements. So for
Okay.
every question, the moment you read the introduction, quickly jump to the requirement and find out what are they asking you to do. So go to the requirement of the question.
So the requirements, it said A, prepare the consolidated statement of profits or loss and other comprehensive income for the year ended 30th September 2019. And B, calculate the consolidated goodwill that arose on the acquisition date.
So we are supposed to prepare a consolidated statement of profit or loss, and then also go ahead and calculate goodwill. So now you can see from the statement that NA Limited is a parent because he acquired 60% of the shares of Shome. So NA is a parent and then Shome is a subsidiary. So immediately you open a fresh page. So do that. Let me assume this is my first page. Immediately open a fresh page and then start consolidating. Start consolidating means let us put down the title. It is NA Limited Group. So title is NA Limited Group. Then consolidated statement of profit or loss, and other comprehensive income, for the year ended, the year is ending 30th September 2019. So 30th September 2019. Our statement is in thousands of Ghana cedis. So let me put here the thousands of Ghana cedis to make it easy. And then quickly, you start summing all items of revenue and expenditure, but leave your bracket open. Just add up all items of revenue and expenditure, leave your bracket open. So when I say sales, when I open bracket, it's 310,000. 310,000 plus 155,000. Then I come down to cost of sales. Now, cost of sales include a lot of adjustments. So if it's possible, use a double bracket. Use double lines as your bracket. 200,000 plus 75,000. Then let's provide for our gross profit. Provide a column for your gross profit. Go and take out the operating expenses, that is distribution cost. So distribution costs, yes, we have 20,000 and 10,000. Make sure you are careful in picking the figures so that you don't pick a wrong figure. If you think you cannot see, you have to draw the lines and make sure you are picking the right figure. Then administrative expenses. administrative expenses. If the write-up is too long, you can add it under it. You can add it under it so that you have a lot of space. Just as I've done, 18,000. So administrative expenses is 18,000 plus, we have 18,000 plus 12,500. Then we have investment income and finance cost. So investment income, we have 2,500 plus 800. Leave your brackets open. Make sure you leave your brackets open because it's possible you can even multiply by a fraction. So leave your brackets open. So investment income, then finance cost. Finance cost. Yes, we have 1,000 and 2,800. So 1,000 plus 2,800. Now, profit before tax. But before you get to profit before tax, leave a line, leave one empty line, so that in case there is an associate hidden somewhere in the question, you can make provision for that associate. Is that clear? This is a
Yes,
technique. Anytime you are working, just before you get to profit before tax, leave one empty line. For example, I'll leave one empty line before I'll provide the column for my profit before tax, so that in case there is an associate hidden somewhere in the footnote, I can be able to provide for the associate. So profit before tax, then I come to the income tax. So income tax, what do I have? 22,500 plus what? 15,500. Once I've done that, I have my profit for the year. So profit for the year. Then I come to other comprehensive income. Other comprehensive income. And then under other comprehensive income, I have a revaluation gain. And then since revaluation gain is a component of equity, and you know in consolidation, the parent has acquired the subsidiary's equity. Therefore, under revaluation gain, you recognize only that of the parent, which was already a loss. So a loss of 1,100. So recognize only that of the parent because the parent has acquired the subsidiary's equity. So the subsidiary's equity no more exists at that point. So you recognize only the parent's equity as a loss of 1,100 in the bracket and then leave it opened so that in case the subsidiary has any post-acquisition revaluation gain, we can make provision for that. At the point of consolidation, remember that the parent has acquired the subsidiary's equity. So at that point, the subsidiary has no existing equity anymore. And since revaluation gain is a component of equity, you take only the parent, just like share capital. You remember when we are consolidating under equity, the share capital, we take the share capital of only the parent. Do you remember that? Do you remember
Yes.
that?
yes.
Yes.
Yes. So for the revaluation gain too, you take that of only the parent. Then again, you also leave one line in case there is an associate, and the associate has a revaluation gain. So you can see the effect of the associate on the consolidated statement of profit or loss is that there will be one line item for a profit from associate just before the profit before tax. Then there will also be a one line item under other comprehensive income in case there is an associate. So whatever I did here and I left one empty line. Let's assume this is my one empty line I left. See, I left one empty line here. Let's assume this is the empty line. I left it so that in case there is an associate, I'll write it there. The same way I'll leave one empty. Are you following?
Yes,
So I'll
sir.
also leave one empty line here before I'll provide my total comprehensive income. So in case there is an associate, I'll take care of the associate there. Total comprehensive income. Now, when you get your total comprehensive income, you are supposed to share the profit for the year and the total comprehensive income. You share it for NCI and then the parent. So you can leave two lines right under it, then you come. Leave two lines under the total comprehensive income. Then you come and see profit for the year, attributable to. That means we'll share the profit for the year for NCI and then the parent. NCI and then the parent. Then you close it. Then you can also leave another line and share the total comprehensive income too. Total comprehensive income. Total comprehensive income. Also attributable to. So you share the profit and then the total comprehensive income for NCI and then the equity holders of the parent. So provide for that sharing. Provide for that sharing before you do your workings. So do this accordingly. Add up all items of revenue and expenditure on a line by line basis for the parent and subsidiary, while you leave the bracket open. Before you get to profit before tax, just immediately before profit before tax, you leave one empty line in case there is an associate. In case there is an associate, we'll tackle it there. Then after the profit for the year, when you get to other comprehensive income, that one to under it, you also leave one empty line in case there is an associate. So you do all that. Then after you've gotten your total comprehensive income, you leave two lines and come and share profit. You will share the profit for the year for NCI and parent. Then you also share the total comprehensive income also for NCI and parent. So do that. Then on the next page, you go to our workings. So let me put here the workings. If you don't want to struggle, just title it all figures in thousands of Ghana cedis because they are in thousands so that you don't repeat the thousands. You can say all figures in thousands of Ghana cedis. I've done this. Now in my workings, working one should be your group structure. Group structure simply means any analysis that will show your percentage control and then NCI and date of acquisition and date of reporting. So I can put my group structure this way, that now limited, I can say now limited acquired Shome. I can put it this way, now limited acquired Shome. Now the control, they say you acquired what percentage? You
Yeah.
acquired what percentage? 60%. So control was 60%. Then NCI will definitely be 40%. When I sum these two, that gives me my 100%. Then put down the acquisition date. What was the acquisition date? When did he acquire?
1st April 2019.
So 1st April 2019. Then what is my reporting date? The reporting date is the date of the financial statement. What is the reporting date?
30th September.
30th September 2019. Now, the period from April to September is a period of 6 months, right?
Yes, sir.
That's your post-acquisition period. Put that down carefully. Put that down carefully. Then right under that, just show an analysis of how many shares was acquired in that order. You will need it. So how many shares was acquired? So under that, right under the group structure, I'll say that right under the group structure, I'll do this. And I say number of the subsidiary is Shome. So number of Shome's share. Now, how many shares did Shome have before the parent came to acquire him? Check.
75 million.
Shome, he has 75 million what? Shares. So you see 75,000. You see, the person had 75,000 shares. Then the parents control. So you see, now limited control. He was controlling 60% of the shares, right? So that is 60% of the 75,000 shares. Try and find out this before you continue because you will need it. So calculate 60% of 75,000 for me.
45,000
So that is 45,000 shares.
share.
45,000 shares. That means that now Limited came to buy 45,000 shares. It is important to get this before you move to your working two. Working two should be your cost of investment. How you are reading the workings does not matter. But the key things is that you should show your cost of investment, net assets, and goodwill. That's the most important thing. So anyhow you put it, I prefer to show my cost of investment separately. So the cost of investment. How was the acquisition done? If you read, it says now limited on 1st April 2019 acquired 60% of the 75 million equity shares of Shopee. The acquisition was achieved through a share exchange transaction of one share in now limited for every 3 shares in Shome. So I can put down here that there was a share exchange. Share exchange. What was the result of the shares? They say one share for every 3 shares. So one for three of the number of shares now acquired. How many shares did now acquired?
45,000.
We've seen clearly that now acquired 45,000 shares. So put down the 45,000 shares. And then who did the share exchange? It was Na. So you use Na shares price at the date of acquisition. Please be careful here. This is where a lot of students make mistakes. It is Na, the parent, who is making the share exchange. So it's assuming the parent is issuing shares. He will use his share price. So go and find out the share price of Na at acquisition. Then you can see it says at the acquisition date, the share prices of both Na and Shome are 4 cedis and 2.5 cedis. So in your view, which one should we use?
4 cities.
4 cedis. That is the one for the parent. Keep this in your mind. It is the parent that is doing the share exchange. So you use the parent's share price. So calculate that for us. I think it will give you 60,000. Then the question says, in addition, Now Limited will pay 1.54 cash on 31st March 2020 for each share acquired. Now, he has promised to pay additional money in future. Remember, he acquired the company in 1st April 2019. If he is saying he will pay some money in 31st March 2020, that's a 1-year period. Do you agree it's a 1-year period?
Yes, sir.
So money that you have promised to pay in future, that is what we call a deferred consideration. The man has promised to pay that money in future. So that is a deferred consideration. So in accounting, keep this in mind. Accounting does not deal with future values. Therefore, whenever you are dealing with anything in accounting and there is some money that a person will pay in future, discount it to present to find the present value. So deferred consideration, anytime there is an amount to be paid in future, discount it to present to find the present value. So deferred consideration, first of all, let's go and find out that the deferred consideration, how much was that future amount? So you let me put that here as working 3. I want to do everything systematically for you. Deferred consideration. Let's find out how much is that future amount. So the future value, he said we'll pay 1.54 cash for each share. So 1.54 per share times, how many shares did he buy? He bought
45.
45 shares. Do you agree? So calculate the future value for me first. I want to know that what is the future value? How much?
69,300.
69,300. So the future value is 69,300. But we have to convert it to present value here. So the present value will be the 69,300, which has been discounted by the cost of capital. So find out from the question, what is the cost of capital of the parent?
It's 10%.
The cost of capital of now limited is 10%. So 1 plus 10% is 0.1. And he said you will pay it in 1 year time. So to the power 1. This is what we call discounting. You see, if you were calculating future value, just as you've been doing, what do you call it? Compound interest. You say future value is the present value times 1 plus r raised to the power n. Is that not what you've been saying?
Yes.
Therefore, if I'm looking for the future value, it will become future value divided by 1 plus r to the power n is equal to present value. So now, if I'm looking for the present value, I'll put that future value of 69,300 here over 1 plus r is the interest rate, which is the 10%, 0.1 to the power 1. And that is what we've done here. So calculate that for us. What does it give us?
63,000.
That gives us 63,000. And you capture your 63,000 here. 63,000. I want to do everything systematically for you to get good understanding. So that gives you 123,000. So this is our cost of investment. Take your time and do everything neatly. After you've learned and you understand, if you now understand, then you can now do it quickly as you want. But as students, I always advise that since you are now at the learning stage, you take everything systematically to get a perfect understanding. When you now have your perfect understanding, you can do whatever you want. Now, working for, which is your net assets. Normally, when you are working the net assets, leave a full page for it because you don't know how long it can be. So net assets of the subsidiary, who is Shome, the net assets of Shome Limited. And then always take the net assets at the date of acquisition, take it at date of acquisition, and then at date of reporting. So at date of acquisition at one side, then at date of reporting. Some will do post-acquisition, forget about it. It's not necessary. What is necessary is you have your net assets at date of acquisition and date of reporting. I'll tell you why it will not be so necessary there. So net assets is equity. Now, this is not statement of financial position where you can see the equity figures. So you need to be very tactical. Let's see how we will be able to do that. We know the first component automatically must be share capital, right? Right? Now, share capital. They told us Shome had 75 million shares. Since they didn't tell us how much the shares were denominated on quotation, it is assumed to be 1 cedi. So 75,000 times 1 cedi will give you 75,000. That means the share capital is 75,000. Then now retained earnings. Retained earnings. The question didn't say anything about the retained earnings. So leave it empty. You don't need to stop. You can still go ahead without the retained earnings. So just leave it empty and keep working. If the retained earnings is somewhere in the question, as you work along, it will come by its own self. Is that clear?
Yes, sir.
At that point in the exam, so you don't have time to be reading through all the questions. No, you are working for marks. So keep on moving. Leave that line empty and keep on moving. If indeed that retained earnings is in the question, as you work along and you take all the footnotes one after the other, it will come by itself. Is that clear? So let's leave the retained earnings empty. If there is a possibility that there is other components like revaluation gain, you leave that one too empty. The three main components are this: retained earnings and revaluation gain. Leave that one too empty. Don't worry yourself. Just leave it empty and go. Then now move to the footnotes. We are going to read the footnotes one after the other to adjust our net assets. Footnote 1. It says on 1st April 2019, a fair value exercise was conducted and it was concluded that the carrying amount of Shome Limited's net assets were equal to their fair values, with the exception of the following. 1. The fair value of Shome Limited's land was 1 million in excess of its carrying amount. So that means that there was a fair valuation of land. So let me say fair valuation of land, 1 million in excess. So add that 1 million, 1,000, 1,000. Now, you know land does not depreciate, right? Land that is being used for production, owner-occupied land, does not depreciate. So that is the end. Then it goes further. It says 2. An item of plant had a fair value of 3 million in excess of its carrying amount. So that one too, there was a fair valuation of land, 3 million. So at acquisition, you add your 3,000. At reporting, you add your 3,000. But this is plant. This is
It's
plant. Listen, you see?
fair value of plant.
Sorry, fair value of plant. Now, this is plant. So since it is plant, you should expect that at the reporting date, depreciation will affect the plant. Is that clear?
Yes.
So you have to read further to find out the policy for depreciation, depreciate the plant. It says that the plant had a remaining useful life of 2 years at the date of what? Acquisition. So now you come here and say fair value depreciation. You see the plant, you have fair value. You have to calculate the depreciation on it. They say 2 years. So 3,000 divided by 2 years. But remember, we have operated for 6 months. So the depreciation will be times 6/12. Is that clear?
Yes, sir.
Remember, in our group structure, we had 6 months depreciation, 6 months post-acquisition period. So that 6 months should affect all items of revenue and expenditure, depreciation. And you know, depreciation only affects the reporting date. So you should recognize it at the reporting date, as I have done. Then it went
Sir,
further.
please,
Yes.
anytime there is an excess of the fair value amount, it means that
Yes.
you have to add it.
Yes. You see, this net assets we are preparing, it is the net assets you see here are at book values. We are restating it from book values to fair values. Are you getting it?
Yes.
When you are selling something, you don't sell it at book value, you sell it at fair value. Exactly.
Yes.
And so we are restating the net assets from book value to fair value. So since we are restating from book value to fair value, if the question is saying a plant had the fair value has an excess of 3,000 against the carrying amount, it means the carrying amount has been recorded already. So if there is an excess of 3,000, then you have to add it to bring it to the fair value. Is that clear?
Yes, sir.
Okay.
That is
Thank
it.
you, sir.
Then you net off your depreciation. Now you go ahead. The question then says again, at the date of acquisition, Now Limited placed 2.5 million on Shome Limited's good trading relationship with customers. Now, good trading relationship is an intangible asset. Is that clear?
Yes.
So they said when Now was buying Shome, Shome has a good trading relationship with customers, so customer relationship, and he valued it at 2.5. That means he agreed to purchase that one at 2.5. So you add it 2,500. It means it has increased its asset. Now, let me do this before I continue. Let me quickly draw your attention to this. Now, when we say net asset, this is a rough word. What this? When we say net assets is the same as equity. Net assets is equity. So it means that we are valuing the equity of the subsidiary. And you know, in accounting, assets is equal to equity plus liabilities. Is that not it? So assets plus liability is equal to equity. So when we talk about equity, the company, the equity of the company consists of and then liability, asset,
Gifty,
liabilities.
please.
Hey, who is making that noise? Gifty, if your background is noisy, kindly mute yourself. If your background is noisy, kindly mute yourself. So equity consists of assets, liabilities, incomes, and expenses. The equity of a company consists of asset, liability, incomes, and expenses. Now, assets and income, they will increase equity. And then liabilities and expenses will decrease equity. So when we say equity, equity is like your wealth as a human being, your total wealth. If you have any income or assets, do you agree to increase your wealth?
Yes.
So any asset or income, you add it. Then if you have an expense or a liability, it will also decrease your wealth. So any expense or liability, you also deduct it. Is that clear? So anytime you are dealing with the net assets of the subsidiary, have it in mind that if there is any additional income or additional asset, you add it to the net assets to increase it. Then if there is any expense or liability, you deduct it. So that is why you can see that since the land is an asset, I added it. The plant is an asset, I added it. But the depreciation is an expense, so I subtracted it. Can you see clearly here?
Yes, sir.
Can you see clearly here? Then the customer relationship is also an asset, intangible asset. So you add it in that order. But since it's an intangible asset, you should expect that it will also suffer amortization, just like the plant. So that one too, amortization. Let's read the question further. It says what? Now Limited expects that this customer relationship will last for a further what? 5 years. So it means that the amortization to 2,500 divided by 5 years. But remember, they've operated for 6 months, so times 6 months, then that will also give you 250, just like the depreciation. Then you net it off. Are you getting the point? Are you
Clearly.
getting? Remember, I've told you you should leave a full page for the net asset. You see how long it is. You may not know how long it will be in the exam source, so leave a full page for it. Then you continue. So I can leave enough space for the net assets. Can leave enough space and then begin somewhere here, calling that my full page. So once I've gotten the net assets, now I'll go ahead and calculate all the other footnotes. So all the other footnotes given to you, deal with all of them. When all of them are finished, then you calculate your goodwill, then you are finishing the work. So let's continue with the footnotes. Note 3. It is the policy of NAR Limited to value land to market value at the end of each accounting period. Before the acquisition, Shome Limited's land had been valued at historical cost, but it has adopted the group policy since its acquisition. In addition to the fair value increase in Shome Limited's land, it has increased by a further 0.5 million since acquisition. You see, they are telling you that the group, they've been adopting the policy of revaluation. And then since the parent acquired the subsidiary, now it has adopted that revaluation policy. And they are saying that in addition to this fair value increase you see here, in addition to this fair value increase of 1,000, which you are seeing here, they said since it was acquired, it has increased by a further 500,000. That means the land has been revalued again, and you have gotten additional revaluation gain of 500,000, which is 500. Is that clear?
Yes.
So revaluation gain is also what? Again, it will increase the net asset. So you come here and also see revaluation of land. That means they revalue the land again. So revaluation of land still under the net assets. Since they said it has increased by 500 since acquisition, it means that it from the acquisition date to the reporting date. So you capture it at the reporting date, 500. So you add it to the reporting date. Once they told you since acquisition, it means that it occurred from acquisition to reporting. So you recognize it at the reporting date. Anything that happens exactly at the acquisition date, then you recognize it at the acquisition date and it will affect the reporting date. But if they told you the thing happened during the post-acquisition period or since acquisition, it means that it happened after they acquired the company. So it will only affect the reporting date. Is that clear? Is that clear?
Yes, sir.
Yes.
Okay, then let's continue. Then it says that note 4, the successful completion of the acquisition resulted in the sale of goods from Na to Shome. Now, anytime two group members sell goods between themselves, it will bring what we call unrealized profit. So I'll go ahead and then work. So you see, I've left enough space to assume that this is my full page. Then I come here to note 5 and see unrealized profit, working 5, unrealized profit. Anytime two group members sell goods to themselves, it will bring what we call unrealized profit. You need to find out who sold to who. They say it resulted in the sale of goods from Na to Shome, valued at 10 million. So you see sales was from Na to Shome. So parent to subsidiary. Take note of this so that you don't forget the treatments. Now, how much was the goods? The goods was 10 million. So we say the sale is equal to 10,000. Then ask yourself, what was the profit policy? They said at 30th September, Shome Limited still held 1/5 of these goods in inventory. So the inventory that is left, you calculate the inventory that is left. They said 1/5. So 1/5 of the 10,000, which will give you what? 2,000.
2,000.
Then you ask yourself, what is the profit policy of the company? It says that Now Limited charged a markup of 25% on cost. It means that the sale was done at 25% markup. So take note of the profit policy, a 25% markup. A markup means a percentage on cost. So now don't realize profit. Don't realize profit. You just take the 25%, but since it's a markup, the denominator should be 125. Is that clear? If it was a margin is a percentage on sales. It means that the selling price will be 100. So the denominator will be 100%. Is that clear? So 25 over 125 times 2,000. And that will give you what? 400. Again, let me demonstrate it here. This is what I'm doing. Cost plus profit is equal to selling price. Now, if it is a markup, it means cost is 100%. So cost is 100%. The profit policy is 25%. Therefore, selling price will be 125%. Can you see? Can you see?
Yeah.
Therefore, you say yourself that now, if the sale, which is 10,000, now the sale is representing 125. So if 125% is equivalent to 10,000, then we are looking for the profit, which is 25%. Therefore, 25% will be equal to what? Less. If less what? More divide, right?
Mhm.
Right?
Yeah.
It means 25 over 125 times, sorry, the inventory was 2,000. So this is 2,000.
That's
2,000.
it.
125% is representing 2,000. Therefore, 25% will be less. If less, more divide. It means 25 over 125 times the 2,000. So this is what I'm doing here. So anytime it is a markup, the denominator should be 100 plus the profit, which is 125. If it is a margin, the denominator will be 100. Is that clear?
Okay. Okay.
Is that clear? So keep this in mind. There is no console person you will not see every day. Unrealized profit will be there for you. They will always tell you markup margin, markup margin. Just have it in mind. If it is a margin, the denominator will be 100. If it is a markup, the denominator will be 125. So 400. Then you ask yourself that now who sold the goods? Unrealized profit, who sold the goods this time? It was the parent who sold the goods. So the profit is in the parent's book. Do you agree?
Yes.
Now, unrealized profit, this is how you treat it. You will deduct the
See,
profit from the profit of the seller, then you also deduct it from inventory on consolidation. So here, since it's the parent who sold, we will deduct this profit of 400 from the parent's retained earnings. And the parent's retained earnings can be found in the last working, which we call consolidated retained earnings. Is that clear?
Mhm.
So assuming it was the subsidiary rather who sold, like it would have affected the subsidiary's retained earnings, which is here. Can you see that in the net asset, the subsidiary's retained earnings is here? So we would have deducted it from the net assets. Are you getting the point?
Yes.
But since it was the parent who sold, we will rather deduct it from the parent's retained earnings, which we are yet to calculate in consolidated retained earnings. So we can leave this and move on. So we can leave this at this point and move on. Note 5. On 1st April 2019, Now Limited purchased 20% of Pamela Limited's equity shares. This is what we call an associate. This is what we call an associate. So, investment in associate. He went to buy associate is a company within which you have between 20% to 50% shareholding. Now, we are saying that he bought 20% of Pamela on 1st April 2019. So the associate, the only thing we need from the associate is the profit from the associate and then his revaluation gain. Are you getting the point? So they are telling you that Pamela Limited's profit after tax for the year ended 30th September 2019 was 5 million. And during the year, Pamela paid dividend of 3 million. So you say that now Pamela's profit, they say was what? 5 million, so 5,000. So the parent will take his share. So the parent's share of that profit from 1st April 2019 to 30th September 2019. Remember, they said he bought him on 1st April. That will be, we control him 20%. So 20% of that 5,000 But this is a period of 6 months. So you multiply it by the 6 months. Is that clear? So calculate for us. 20% of 5,000 will be 1,000 times 6 months will be 500. Meaning that the profit from the associate is what? 500, right?
Mhm.
Then you also find out the dividend. It said during September 2019, Pamela paid dividend of 3 million. So you see the dividend received. So the dividend that you received from the associate. If the associate paid a dividend of 3 million, how much is the parent share? It will be 20% of that 3 million. Are you getting it? Are you getting it? The associate paid a total dividend of 3 million, but the parent controls him 20%. So the parent will get 20% of the 3 million, which will give you what? 600. When we get to the statement, I'll show you how to treat this. Now, who can tell me why I didn't multiply this by 6 over 12? I did not multiply this by 6 over 12 because if you read the question, it says, and during September 2019, Pamela paid a dividend of 3 million. If they use the word during September 2019, it means that it is already during the post-acquisition period. Are you getting it? The acquisition period ends in the post-acquisition period ends in September. So if they use the word during September 2019, it means this thing happened during the post-acquisition period. So it's already covering the 6 months. Are you getting the point? Are you getting the understanding? Hello?
Yes, sir.
Yes, sir. We are
If
with
they
you.
said during September 2019, it means they are saying during the post-acquisition period. And the post-acquisition period is already 6 months. It means this 3,000 you see here is already covering the 6 months. So you don't multiply by 6 months again. But then, for the profit, look at the question. It told you the profit for the whole year. They said it's profit after tax, permanent profit after tax for the year. So the profit of 5,000 was for the whole year. That's why we multiplied it by 6 over 12 to take the post-acquisition one. Is that clear?
Yes,
Yes.
sir.
Good. So anytime they use the word for the year, it means that is for the whole year. So you take your share by multiplying by the number of months you have operated. But if they use the word during the post-acquisition period, it means that it is already covering the post-acquisition period of 6 months. So you don't multiply by 6 months again. That is why in the unrealized profit here, you see that the 2,000, we could have multiplied the 2,000 by 6 over 12. But the reason why we didn't multiply it by 6 over 12 is that they said during the post-acquisition period. Let's go back to footnote 4 and analyze this. If you look at the footnote 4, it said the successful completion of the acquisition resulted in the sale of goods from now limited to Shomel. You see, they said what? The successful completion of the acquisition. The reason is that the unrealized profit, the sale of the goods happened during the post-acquisition period. Is that clear? So because it happened during the post-acquisition period, it has already covered the 6 months. So you don't multiply by 6 over 12 again. Are we getting the difference? Are we getting the difference?
Yes.
Yes, sir.
The sale of goods between the two of them, it happened during the post-acquisition period. Therefore, you don't multiply by 6 over 12 again. But if they tell you for the whole year, the sales for the whole year, then that one you multiply by your 6 over 12. So that is just by the way. Let us move on. Let us move on. Note number 7. In September 2019, Now Limited also sold goods to Pamela for an amount of 7.5 million. Then, like I said, anytime there is a sale between any of them, it results in what we call unrealized profit. So there is an unrealized profit again. Let's still go ahead and calculate unrealized profit. This time we sold to Now Limited sold to Pamela. So parent sold to associate. Parent sold to associate. Then it says that for an amount of what? 7.5. You see, they said in September 2019. That means during the post-acquisition period. So we will not multiply by 6 over 12. Are you getting it now?
Yes.
Are you getting it now? So the
Yes.
sale, what? 7.5 million. So we say the sale is 7,500,000. And then they say what? all of which were in inventory. So it means that the inventory is all the 7.5. So inventory is the whole 7.5. The whole 7.5. And it says that as at 30th September, Now Limited charged 25% markup on cost, meaning that it was at a 25% markup. It was at a 25% markup. So that one too, the unrealized profit, again, the same thing. Unrealized profit, since it's a markup, it will be 25 over what? 125 times 7,500. But in an associate, take this for me. In an associate, you don't have control. So there is no NCI. NCI simply means non-controlling interest. Where you have control, that is where there is a non-controlling interest. But if you don't have control, there is a no NCI. So everything in the associate, the parent will take his share. So times the 20%. So anything involving the associate, you multiply by the percentage you own. So you see here, because there is NCI, you don't multiply by your percentage because you have control. So it's assuming everything belongs to you. You will take everything before you give the NCI a share. But in an associate, you don't have control. So you only take your percentage. Is that clear? Is that clear?
Yes.
Very clear.
Yes.
It's like, let me explain it in this way. It's like you and I have contributed to go and buy a football. Two of us, we contributed to go and buy a football. The football was 1,000 cedis. Then I contributed 800 cedis, and you contributed 200 cedis. Who will take hold of that ball? Who is supposed to keep the ball? I contributed
The
800. Very good. The 800 will keep the ball. So in subsidiary, you have control. So since you have control, it's assuming that you take the whole 100%. Then at the end of the period, you give him a share of the 40% so that you'll be left with what, 60. That is why everything we are doing here, the parent is taking everything, because at the end of the period, you share profit. So you give him a share. So everything involving the subsidiary, the parent will take control of everything. At the end of the period, then you give him a share. But in an associate, you don't have control. You are controlling only 20% is what you have invested. So anything, you are only entitled to your 20%. Therefore, unrealized profit, anytime it involves the associate, you multiply by the percentage you own in the associate. Are you getting it? So
Yes.
calculate that for us.
300.
That's how much? 300, eh?
Yes.
So that's 300 cedis. 300. We are done. So we are finished with that footnote. We are moving to the next footnote. You exercise patience. When I finish, I'll give you the chance to write before we fill the statement. We have time. I'll give you the chance to write. So let's move on. Then we move on. The question went ahead. In footnote number
7.
7, it is the policy of Now Limited to value non-controlling interest at acquisition date at fair value. For the purpose of this, the share price at acquisition date is representative of the fair value of shares held by non-controlling interest. So they are trying to tell you that we should value NCI at fair value. So let me say, this is how you value it. I'm calculating everything for you to see. This will be working 8. So let me say working 8. NCI at acquisition. This is what they mean. They say you should use the share price. So you multiply NCI shares. Now, the parent had 75,000 shares. And then the subsidiary has 75,000 shares. And the parent bought 45. So NCI will control 75,000 minus 45,000. Is that not it?
Yes.
So that was 30,000 shares, right? So NCI has 30,000 shares. Then you multiply by the subsidiary share price. You know, NCI is in the subsidiary, right? So they said the subsidiary share price is representative. What is the subsidiary share price? From the beginning, they told you the share price of subsidiary is 2.5 per share. So multiply that, let's see. 30,000 times 2.5. That's 75,000. Exactly.
Yes.
So this is how you value NCI attack. So that is that. Then note 7. The retained earnings of Shome Limited brought forward to 1st October 2018 were 60 million. You see where they put it? This retained earnings we're looking for. Look, when we did the net assets here, this retained earnings we're looking for, that we left. You see now, look at where they put it on the retained earnings of Shome Limited, brought forward to 1st October 2018, were 60 million. You see? So if you were waiting, reading the question to see if you will find it, do you see you would have been wasting your time? Do you see you would have been wasting your time?
Yes.
Yes, that's why I asked you to continue. When you get there, if indeed that figure is there, you will see it by yourself. So let's go and see. Retained earnings of Shome. I'm working everything for you to understand clearly. So retained earnings of Shome. They said as at 1st October. So as at 1st October 2018, as at 1st October 2018, he had 60 million, that's 60,000. Now, when did we acquire the company? When did we acquire the company? We
Yes.
acquired in April 2019, right? So if he has 60,000 as at October 2018, then he worked from 1st October 2018 to 31st March 2019 before they acquired him. This is a period of 6 months. So 6 months of his profit. Now go to the statement of profit or loss, and give me Shome Limited's profit for the year. His profit for the year was what?
40,
Shome Limited, what is his profit for the year from the statement?
40,000.
40,000. That means he worked for a further 6 months to give you 20,000 before they acquired him. So as at the acquisition date, 1st April 2019, he had 80,000. Do you agree? Do you agree?
Yes.
Then he worked again from 1st April 2019 to 30th September 2019, which is also a period of 6 months. 6 months again of 40,000, also giving you what? 20,000. And it means that at the end of the period, 30th September 2019, he has 100,000. 100,000. So what it means is that the retained earnings at the acquisition date, 1st April, is 80,000. Then at the reporting date, 30th September, is 100,000. Do we understand? Do we understand? Hello, my people. Are we understanding it?
Yes.
Yes.
Yes, we are following.
We go back to the net assets. Then you say the retained earnings at the acquisition date is 80,000. And then at the reporting date is 100,000. Then you put it there. So put the 80 and 100 there. The question didn't say anything about revaluation. It means there is no revaluation. So dash. That's the game. So go and put your 80 and 100 there. Go and put your 80 and 100 there. Now, it says all items of revenue and expenditure are deemed to accrue evenly throughout the period. So we finish. So the moment you finish all these footnotes, now it means that we've virtually finished with the question. So we can go ahead and then now calculate our goodwill. So we can go ahead and calculate our goodwill. So let me say goodwill. Goodwill. Yes, so cost of investment. Goodwill, we'll start with the cost of investment, which we got in working two. If you remember, let's go there and see the figure.
123,000.
That's it, 123,000 here. So 123,000 cost of investment. Then the NCI value at acquisition. NCI at acquisition, which we've worked in working 8.
75,000.
75,000.
5,000. So add it and let's see the whole 100% consideration. So this is the 100% consideration, what they both paid.
198.
198,000.
198,000. Meanwhile, what is the value of the company? Net assets at acquisition. So net assets at acquisition. Now we can go and close our net assets. So you see, now that you finished all the work, you can go back and close your net assets because now you have all the figures. So let's close our net assets. Now we have all the figures. So let's close our net asset like this. Close it. Calculate everything at acquisition. Sum it all. Let's take our calculator and sum. 75,000 plus 80,000 plus 1,000 plus 3,000 plus 2,500. I'm getting 161,500.
Confirmed.
161,500. Then let's go to the reporting date. Let's take our time gently. The reporting is 75,000 plus 100,000 plus 1,000 plus 3,000 minus 750 plus 2,500 minus 250 then plus 500. I'm getting 181,000. Is that clear?
Confirmed.
Good. So let's go there. The net assets at acquisition is 161,500. So that is 161,500. Take it out of this. What do we get as the goodwill at acquisition? Goodwill at acquisition. Yes. What is it?
36,500. 36,500.
500. So that is where when there is an impairment, you take it out. Our next meeting will solve a full question involving P&L and statement of financial position. You see. So this is my goodwill. So when I do all this, I have finished with the question. Then I'll come to my statement and adjust the statement. Are we getting the point? So those who want to write, I'm giving you the workings from working one right before we complete the statement. This is the workings. Copy it from working one. Take your time and copy from working one. I'm giving you 5 minutes. You are copying all your workings so that you have everything intact. Then when we are adjusting the statement, you understand. Have you written the group structure?
Yes.
So continue with this number of shares. Make sure you write everything. Take your time and write everything. I have time for you. Take your time and write. I'm giving you 5 minutes. You write everything up to 5:38. Then we use 5 minutes to adjust the statement. We finish. So take your time and write. So write your cost of investment, your deferred consideration, write everything. The last time I did management accounting with you, I saw some familiar names, but today I'm not seeing them. Does it mean they are not online? Where are they? The familiar names I saw in MA, or they are doing only MA?
Hey,
So,
sir,
only MA.
when do you have the ME?
MA is Tuesday, so tomorrow we'll have
Tomorrow.
management
Tomorrow
accounting.
done. Okay. All right, sir.
We'll start a bit earlier, at 4 a.m. exactly, we should start.
Yes, sir.
Have you written your cost of investment and your deferred consideration? Have you written them? Have you written this? Have you written all this? Oh, please respond to me so I know if I'm moving or
Yes,
not.
sir. Yes. 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 Yes.
So if you've written this, then move to this, the completion of the net assets in the order. Move to this and write it. This is, the word here is associate, investment in associate. Let me write it well for you. It is investment in associate. That is investment in, the word is associate. Write it well. Take your time and write. Are you done with this side?
Yes, sir.
Are you done with this side?
Yes.
Then
We
the
are
last one.
done.
Finish with the last one. And let's balance our statements. Every console you solve, it must balance. If you solve a console and it doesn't balance, then you have a problem. Because console is one of the areas you can, especially you those doing FR. As for the level 3s, we'll continue with complex groups. From next week, we'll do complex groups. But you the level 2s, yours is just basic groups. So if you go to the exam so and then 20-mark question, you can't get 18 out of 20, then you are joking. Make sure you fire about 18. Then your interpretation to 20, you fire about 15. That the 12 will give you 33 marks. You are just left with 17 to go. So make sure that immediately you start with 30 minutes, fire your console, 30 minutes, fire your interpretation. If you get about 18 in console, about 15 in interpretation, that is about 33 marks. At least your ethics will give you some 5 marks. When you add it's about 38. You are now going to do preparation of financial statements and then standard square. You just need some 10 to 12 marks from there to get your 50 and then walk away.
In fact, the way you do the presentation, if all other people who teach the course also do as you are doing, I mean, the pass rate will be very high at all times.
But we are not the
I
same,
like the way you are
but we are not the
presenting.
same human beings. We are not the same human beings. So how can we all do the same thing? You have to learn hard. Don't shift blame on lecturers. When you are taught, you have to learn. Even if angels teach you and you don't read, what can you do? When you are taught, you have to learn. So every day, students will blame lecturers when they don't do well. When you are taught, you have to learn.
But in fact, those of our lecturers in the university, they wouldn't even get time to be doing these things. So
But that is the university. Here is not the university. Here we are writing professional exams. So forget about the university and then learn. Say university, you are undergrads, and then we are Kuala. Now here you are now training to be a professional. So the tempo will increase. Are we done? Are we done with this? So we can balance our statement.
Yes.
Yes, sir.
Now look at something here. When you did the deferred consideration here, immediately you've deferred some amount into the future. It will come with interest. Are you getting it?
Yes.
That interest is what we call unwound. So let's calculate it here so that we don't forget. Let's do working 10 and call it unwound discount. Unwound discount. So the unwound discount. Now, the deferred consideration, the present value was what?
60,000.
The deferred consideration. Present value of the deferred consideration. You said what was 63,000.
Yes, sir.
Now we've operated for 6 months. So the 6 months interest. The 6 months interest. Remember the interest rate was 10%. It means 10% of 63,000 times the 6 months. And that will give you what? 63,000 times 10% times the 6 months. Give you what? 3150, right?
Yes.
That's the one discount. So put this down and let's balance our statement and walk away. Put this down. Let's balance our statement and walk away. Are you done?
Yes, please.
Yes.
Okay, so let's go to the statement and balance. We are going to use the workings to balance the statement one after the other. So our working one, from what you have on your books, working one is the group structure. Do you remember the post-acquisition period was 6 months? Can you see it was 6 months?
Yes.
So every figure of the subsidiary multiplied by 6/12. Every figure of the subsidiary times 6/12. Every figure of the subsidiary times 6/12, as I'm doing. Every figure of the subsidiary times 6/12. Everything of the subsidiary times 6/12. Always remember, if you forget it, you are doomed. That's why I always finish working before I balance my statement. Every figure of the subsidiary times 6/12. So do this first. As for revaluation gains, only the parent. So you don't multiply anything by 6/12. Everything of the subsidiary, multiply by 6/12. Have you done that?
Mhm.
Have you done that?
Yes.
Now, what is your working tool? Your working tool is what? Cost
Yeah.
of investment. Now, the cost of investment, it doesn't affect P&L. It affects statement of financial position. We'll see it in our next lesson. Deferred consideration doesn't affect P&L. But then when you go into the net assets, the incomes and expenses there, apart from the first three, which is automatic, apart from these first three, now you look at the incomes and expenses there. Land is not an income, it's not an expense. Plant, you are looking at the reporting date. Please look at, we are now reporting, so you are looking at the reporting date. So your eyes should be on the reporting date. Land is an asset, it's not income, it's not expense. Plant is an asset, it doesn't qualify. But depreciation is an expense, 750. Can you see? Can you
Yes,
see?
sir.
750. Now read the footnote where that depreciation is. They told you where to record the depreciation. They said footnote number 1, the second one is a plant depreciation is charged to cost of sales. Can you see that?
Mhm.
Can you see that?
Yes, sir.
So you go and add the 750 to cost of sales. So go to your cost of sales and then add 750 plus 750. You can put working 2 on top so that you working 3 on top so that you remember 750. Then let's go ahead. Add the 750 to cost of sales. Then let's go ahead. Customer relationship, 2,500 is an asset. No. But the amortization is also an expense. And then when you look at note 2, they said amortization of intangible asset is charged to administrative expenses. Can you see that? Can you see that?
Yes, sir.
Note 2, the end. They said amortization of intangible asset is charged to administrative expense. That means that 250, you have to charge it to administrative expense. So we also come to administrative expense, then we add the 250. So plus 250. You can put working 2, working 3 on top so that you remember anyhow you do it. So we've charged that there. Add the 250 to admin expense. When we are done, then the revaluation. Now the revaluation of 500, which is now for the subsidiary, you can now come to revaluation here. You can now come to revaluation here, which is here. As the revaluation gain. The other comprehensive income, where you took only the parents, you can now add that 500. You can put working 3 on top so that you remember. You can now add that 500. So go and add the 500 to the revaluation gain there. Are we following? Are we following?
Yes, please.
Then you move. Unrealized profit. Yes, unrealized profit. You treat it in cost of sales. You add it to cost of sales. So the 400. Now, first of all, the treatment of the sale, the intragroup sale of 10,000. It is a sale to one person. It's a purchases to another person. Is that clear? Is that
Mhm.
clear? If
Yes,
I
sir.
sell goods to you, to me it's a sale. To you, the one who bought it, it is a purchase. So since they are now coming together, the idea of consolidation is that any intragroup item, you have to eliminate it from the financial statement. So the intragroup sale of 10,000, you go to the sale and the purchases. So you cancel the sale of 10,000 from sales here. So minus 10,000 from sales. Then you also subtract it from cost of sales. That's purchases, 10,000. So you cancel it from sales and cancel it from cost of sales. Do that. Do that. That's working 5. So do that. You cancel it from sales and cancel it from cost of sales. That's working 5. Deduct it from sale. Deduct it from cost of sales. Have you done that? Have you done that? Then the unrealized profit of 400 is a cost. So add it to cost of sales. So add the unrealized profit of 400. You see why cost of sales? I told you to use double lines. You see why I told you to use double lines? Because the treatments there are many. So add the 400 unrealized profit. Add it to cost of sales. It's an additional cost. So add it to cost of sales. Add the 400 to cost of sales. Please, are you doing it?
Yes, sir.
Then we move on. Let's move on. Investment in associate, yes. So the profit from the associate, the parent share of the profit, the 500. That one single
If you
line,
do now something.
that one single line you left here, that one single line you
Always. Hey, Salwa.
write it there, profit from associate. You see that one single line you left? You now capture it there, profit from associate. 500. So record your 500. You see that one line you left, go and record the profit from associate, the 500. That is working 6. So working 6. Record that 500. Then, now, the moment you've recorded the profit, if the associate has paid any dividend, the parent would have recorded it as an investment income. Is that clear? Is that clear? If I buy an investment and they pay me dividend, I'll record it as investment income. Is that not so?
Yes.
So you go and cancel it because you've already recorded the profit. So you go and cancel that investment income of 600. Go and cancel it. Deduct it from investment income, the 600, the dividend. That's this value, this dividend. You go and cancel it from the investment income. Once you've taken your profit,
Please,
yes.
the unrealized profit, there was a part that was attributable to the associate. Is it because it's a
No, hold on. Don't jump the gun. Don't jump the gun. We haven't gotten there yet. We are now on working 6. When we get there, we'll treat it. We are taking the workings one after the other.
Okay.
So you don't jump. In exams, or you can easily skip something. So take it one after the other. We've done don't realize profit in working 5. Now we are in working 6. Investment in associate. Treat it. If we reach there now, we are now going there in working 7. So don't jump the gun. Is that clear?
Yes, sir, please. Thank you.
Yes. So now let's go working 7. Unrealized profit, the one that's also 300 is a cost. So go and add it to cost of sales. Are you okay now? So go
Okay, I'm fine now.
Go to cost of sales. Go and add it 300. Working 7. I don't want you to get confused. So I'm taking it step by step.
Okay.
Follow your workings gently. The answer will come. You are not in a rush. So that 300, go and add it to cost of sales again. Can we move on? Can we move on? Can we move on?
Yes, sir. Yes.
Okay. NCI does not affect it. Retained earnings does not affect it. The goodwill will finish. But the unwound discount, this is interest. Additional interest is a finance cost. So go to finance cost and add the interest of 3150. Go to finance cost. Add the interest of 3150. So plus 3150 working 10. Add that interest of 3150. If we are finished, then now let's sum it. If we finish, let's sum it. The sales. Now, if you are summing, do the one with the fraction first. Be careful. 5,000 times 6 over 12. Do the one with the fraction first before you add the rest. 310,000 minus 10,000. Please help me with the summation. I'm getting 377,500. So close it. Before you report, make sure you close it. Then you report 377,500. Check if my figures are correct. Take your time and multiply the fraction one first. I'm getting 228,950. Am I correct? Am I correct? Hey, you people are not adding for me.
So we are adding.
And it looks like me, the lecturer, is rather adding more quickly than you. The gross profit is 148,550.
Okay.
Please check my figures if they are right. Distribution cost, let me close it and record. Is 5,000 plus 25,000. Admin expense. Let me close it and report. Hey, I didn't multiply this by the 6 over 12. I didn't see this. Please let's be careful. The admin expense here, I didn't see this. The 6 over 12 here. The 6 over 12 here. Remember, I didn't see that. 6 over 12 plus 250. Working 2. Yes, so 12,500 times 6 over 12. I'm getting this plus 18,000 That's 250. 24,500. That's what I'm getting. Are my figures correct? Are my figures correct? This is 2,300. Investment income is a plus. Be careful of the additions and subtractions. Finance cost. I'm getting 5,550. So let me sum my profit for 148,550 minus 25,000 minus 24,500 plus 2,300 minus 5,550. I'm getting 95,800 plus 500. I'm getting 96,300. Please check if I'm right. You're confirming my calculation of the figures. You're confirming my calculation.
That's right.
Is the figure correct?
Yes, please.
So profit before tax 96,300 is correct. So it means my figure is correct. From the solution, that figure is correct. Then income tax. 15,500 times 6 over 12. Whatever I get plus 22,500. I'm getting 30,250 here. 30,250 there. When I let it go, I'm getting 66,050. Then this one is giving me a negative of 600. I'm getting 65,450. This is what I got. So put it down and let's share the profit. And then we call it a day. Put it down and let's share the profit. Are you done?
Yes.
Now I've taught you so you can copy. I've taught you the answer is correct, so you can copy. If you are done, let's share the profit. So you go and work your last working. You go and do your last working, 11, which you call it NCI share. You call it NCI share of profit and total comprehensive income. NCI share of profit and total comprehensive income. You are sharing both the profit and total comprehensive income. So you can put profit for the year at one side, profit for the year, then total comprehensive income at another side. I'm doing it all at once. There is no need wasting time doing it one after the other. It's the same thing. So profit for the year at one side, then total comprehensive income at another side. Now take the subsidiary's profit for the period. Shome's profit for the period. Now, what is his profit for the year? Shome, his profit for the year was 40,000, but we have operated for only 6 months. So 6 months of 40,000. It will give you 20,000. Then you put the 20,000, it will affect profit. It will also affect total comprehensive income. Anything that affects profit will also affect total comprehensive income. Are you following? Are you following?
Yes.
Yes, sir.
The adjustments to profit, there are 3. You will deduct this unrealized profit where the subsidiary was the one who sold. Remember, NCI is in the subsidiary. So if the subsidiary was the one who sold, we didn't have that. What we have, it was the parent who sold, remember. Then you take your fair value depreciation out. Depreciation was 750. It will affect this. It will also affect total comprehensive income. The same way depreciation is there, amortization too is there. Once depreciation qualifies, amortization will also qualify. There are only 3: unrealized profit, depreciation, and impairment. Amortization was also 250. It will also affect this as 250. So these three, unrealized profit, depreciation, and impairment. If there is an impairment, and NCI was valued using fair value method, keep that in mind. If NCI was valued using fair value method, you would have deducted it. But since there is no impairment, nothing. Then the revaluation gain. Now, revaluation gain it falls under other comprehensive income. So that will affect only the total comprehensive income. Is that clear?
Sir.
The revaluation gain, it will not affect profit, but it will affect the total comprehensive income. So you record that one in only the total comprehensive income. Then you adjust it. So adjust the profit. So calculate this. So this will give you 19,000. And this will give you 19,500. Then you calculate the NCI share. Remember, the parent has 60%. NCI will have 40%. So 40% of 19,000 will give you 7,600. Then 40% of 19,500 will give you 7,800. So that is it. So copy this down. Only three adjustments affect the profit. That is unrealized profit. If the subsidiary was the seller, then fair value depreciation, and then impairment. They affect the profit. And everything that affects profit should affect total comprehensive income. But if there is a revaluation gain, it will affect only the total comprehensive income. Why? Because revaluation gain falls under other comprehensive income. So it falls beyond the profit. It doesn't affect profit, but it will affect total comprehensive income. Please, are you done? Are you done? Hello, are you done?
Yeah.
Okay, so you come back to your statement. So it means that profit for the year, NCI got 7,600. And then for the total comprehensive income, NCI got 7,800, right? For total comprehensive income, we got 7,800, right? Meanwhile, please do you understand? Please do you understand this? For the profit for the NCI got 7,000. For the profit for the year, NCI got 7,600. But for the total comprehensive income, NCI got 7,800. Then you come back and take the profit. Now, this is the profit for the year, 96,300. So you put it here. This is the profit for the year, 93,600. So you put
So is that the 66,550?
the profit for the year. I'm
Yes.
taking okay. That was 66,050. Sorry. The profit for the year is 66,050.
Which medical for hospital for here?
Just it. Yes.
66,050. You put it here, 66,050. Then the total comprehensive income. What is your total comprehensive income? 65,450. Then you also put that here, 65,450. So at the end of the day here, you can subtract. So you are subtracting 66,050 minus the 7,600 to see the balancing figure. So do that.
58,450.
That's 58,450. And then this
57.
one, 65,450. Also minus 7,800. So subtract to get the balancing figure.
57,650.
57,650. That is it. Then you are 100% correct. So you can put that down. Are we fine? We are finished at exactly 6 o'clock. In our next meeting, we will solve the November 2020, and then we say game over for console. When we solve that, it will address all the issues on console. That is both P&L and statement of financial position. We'll tackle that comprehensively to address all your issues on console, so that now level 2s can be separated from level 3, because now the level 3s will continue with complex group where there is an additional subsidiary. You level 2s, your bones are not matured for that. So that is it. So this is a recap of the whole work from here. This is our work. Please, are you done with everything? Are you done with everything? Yes. Are you done with everything? Good. So my name is Enoch Mensah Jr., popularly called Bishop. So I'll come occasionally to help you with your financial reporting, corporate reporting, and management accounting. I'll come occasionally early in the morning to help you with solutions to your past questions so that you sharpen yourself and prepare ahead of your final exams. I take this opportunity to wish you a happy new year. We will meet again. When is your next meeting on FRN and CR? When is the next meeting? I think you have the timetable. When is the next meeting? Okay, we'll share the timetable on the page again and confirm. I think it's somewhere within the week or next week, whatever time it is. Until then, may the good Lord be with us all.
Thank you. Thank you.
Thank you so much, sir.
Thank you so much.